In this mini lecture, we'll continue by looking at the internal assessment. In this section, we'll look at finance, accounting, MIS, and analytics. So the finance and accounting functions are comprised of three decisions. One is our decisions to invest, our financing decisions, and then the dividend decisions. So investment decisions, sometimes called capital budgeting, are the allocation and reallocation of capital and resources to projects, products, assets, and then other divisions. And so what we're really looking at is where do we want to invest? Do we want to invest in certain products, certain projects? Do we want to invest more of our money into a specific division of an organization? So where are we going to put our money is basically what we're looking at here. Our financing decisions determines the best way for a firm to raise capital. And so again, this can be through a loan, it can be through stock. There's a bunch of different ways that we'll talk about later. And then the dividend decision looks at issues such as the percentage of earnings paid to stockholders, stability of dividends paid over time, the repurchase or issuance of stock, and it determines the amount of funds that are retained in a firm compared to the amount of money that's paid out to stockholders. So assume we have $100, which I know is just a really small amount, but let's assume a firm has $100. They would say, okay, we're going to, how much of this $100 are we going to keep inside our company, and how much are we going to pay to our stockholders? And that's what is really in the part of the dividend decision. All right, so we also want to look at our financial ratios and how they've changed over time, how they compare to industry norms, and how each ratio compares with our competitors. And so we'll look at, you can actually kind of look at this on your own in your book, but these are some of the more common ratios. And so we look at our current ratio, which is our assets are divided by our liabilities, so the extent to which a firm can meet its short-term obligations. Our quick ratio is our extent to which we can meet our short-term obligations without relying on the sale of inventories. And so you can go through all of these. This is a great tool to use, a great resource. So leverage ratio is kind of looking at how much, you know, how much we rely on our creditors. Um, we also can look at our activity ratios. So our inventory is a big one, and it really helps us to determine how often we turn over our inventory, how quickly we receive payment, etc. So you can look at these. We have profitability ratios. I think that these are probably some of the things we're most familiar with. So, our gross profit margin, our net profit, our return on assets, our return on equity, earnings per share. Again, you can read about these and ask me questions if you have them. And then we also have our growth ratios, so our sales, our annual percentage growth, our net income growth, etc. So these financial ratios are really important because they help us to, like we said, if we go back, they help us to see how they've changed, whether they've improved or gotten worse, how we compare to the industry, and then how we compare with our competitors. It helps us to really evaluate where we stand. Okay, moving forward. We also want to be aware of, oh, okay, sorry. So when we look at our finance and accounting audit checklist, we're looking at things like, are we strong and weak? Where are we strong, where are we weak, as indicated by our ratios? Can we raise short-term capital? Can we raise long-term capital through debt or equity? Do we have sufficient working capital, like so cash on hand, and just money to keep moving forward? Are we good at budgeting? Is our capital budgeting procedures effective? Do we have a good dividend payout policy if we're issuing stock? How are our investor relations? Do we have good financial managers? What does our debt look like? These are important questions to ask ourselves. We also want to look at, the next step would be looking at our management information systems, or our IT. And so here we use data, or we have we use information to help us to evaluate and make decisions. So when we're looking at our management information systems, usually we're using computers and so forth to collect, code, store, synthesize, and present information to help us to make decisions. So it's a very important aspect, and I think we've all heard the term big data because companies are collecting so much data, and there's so many opportunities to use this data for good. And so this is where business analytics comes in, and this is where we use this MIS or this IT in our software to collect large amounts of data and then to mine it. And basically, we're mining data by trying to pull out trends or to try to uncover information that can help us to make decisions. And sometimes this is called predictive analytics, machine learning, or data mining. All right, and so what we're really trying to do through all of this is gain and sustain a competitive advantage. So here and this is kind of what we're going to be talking about all semester. So we're establishing a clear vision and mission. We're formulating strategies, collect, analyze, prioritize data. We're implementing strategies through marketing, management, finance, accounting, IT, and then we want to evaluate and monitor um, and take corrective action or change based on what we learn, and then the process starts all over again. So one tool that we can use to help us to do this is the internal factor evaluation matrix. And so this is really similar to the EFE where we list, here we're listing our key internal factors, so our strengths and our weaknesses. We weight them and we give them a rating. We multiply our weight and our rate and we sum it up. So here's an example. So we look at this is for a retail computer store. So we look at our key factors, we weight them. Remember that our weights for our strengths and our weaknesses need to equal 1. We rate them, 1 being we're not so good at that, and 4 being we're pretty good at that. We get a weighted score. We do this for both our strengths and our weaknesses. Remember the weights from the strengths and the weaknesses need to equal 1. And then we come up with a weighted score. Here we're at 2.50, which would be we're about average. So we would kind of go through these and we'd say, well, this has a really big weight and our rating's not so good on it, so maybe we can make some changes um, to try to drive more revenue from our software segment. All right, or maybe we'll go to our strengths and we'll say, okay, employee morale is really important. It's pretty high. Okay, that's good. Is there anything that's not so good on here where we can make changes? Well, maybe what we can work on. I don't know this company's pretty good. Maybe we can increase our revenues from repairs and services to try to bump that up a little bit. And so that's what the IFE looks at is evaluating our strengths and weaknesses and to determine where we stand. All right, so that is um, the end of chapter 4. I hope these mini lectures have been beneficial to you, and I'll see you soon.